more than $50,000. Okay? To get the full $25,000, your house actually needs to be more than $75,001. So, on the second tier, we're actually going to need this is all for the basic deduction. Then you have a second deduction. On the second deduction, we're only going to use 2 taxing authorities. So we're going down to the local, which is the county, and we're only going to take the city. So now we're going to use 2 taxing authorities. I'll make a comment. This is not a difficult concept. It's multiply mills time whatever the assessed value is. Then it's multiply the mills times the first 25,000, and then our problems are always greater than, the house is always worth more than 75,001, so we take the second 25,000. So all we do is we get 25,000 here, and we multiply that by whatever the mills are, right, for all 3. Over here, our problem tends to be over 75,001, so we get the second 25,000, and this time we multiply it by the mills, and we're only going to use 2 taxing authorities. We all good so far? So we'll go through a little bit more, but I want to put that out there because that's where people struggle. Let me make a difference. Let me make a comment. This makes a difference between probably getting literally a 70. You could be off by 1 point. This is a math problem. This is always tested on the state and on the school. They give you one of these problems, so you have to understand taxes. Even though it's low-hanging fruit, it's the difference between a 74 and 100. Okay? Because on the state exam, you get a 75, you'll never know. It'll just say what? Pass. But if you get less than 75, you'll know why. And if it's this, you're gonna kick yourself in the butt. Because it literally is just multiplication, and then just subtract, and total. Okay, so it's not a very difficult concept. Okay, okay. Now, what happened?
So it's always 25 on both?
Yeah, because they're gonna use greater than, the house is gonna be worth more than $75,000.
Okay.
I'm gonna teach you how to do the other one as well, right? But our problems tend to be greater than 25, everybody gets this. This is mandatory. This is basic. Because in Florida, they talk about a $50,000 homestead exemption. It's not really true. They actually have to break it down between layers. And this full $25,000 assumes that the assessed value of your house is 75,001 or higher. Right? Other than that, this is the basic. This is good from 0 all the way up to $50,000. Right? Everybody gets the basic. Now, we got to talk about mills. Mills is not a difficult concept. Here they talk about 10 mills. All you're going to do is take the mill and convert it to a decimal place. And it looks like this. So if I say 25 mills, you're going to say what? 0.025. If I say 35 mills, you're going to say 0.035. If I tell you 125 mills, you're going to go 0.125. Okay? So you follow me through there, you should be in good shape. Now, I don't understand what's wrong with my system. Florida has a rule. City, county, and school board will never exceed 10 mills each. The cap is 10 mil. So the highest mills you could ever be exposed to is actually 30 mills. Right? There's 3 tax authority at each 10, so the maximum is 30 mills. I don't know what's wrong with my computer. computer, but.
So max combined 30 mils.
Yep. So the way it works is this, the property appraiser has to come up with the assessed value of your property. Now what we're gonna do, we're gonna turn around and we're gonna deduct our exemptions. So you get a taxable value for your property, that's your assessed value, then I calculate tax liability. Once I do that, good morning, you're in the wrong class, go to A. You're
It's
looking for
across the
Fred,
hall.
right?
Yeah,
A,
all right.
okay? So, we've gotta get the taxable value. The way we do that is we take the assessed value, multiply it by the mills, we get the taxable value. Then we're gonna take the assessed value, then we're gonna take the exemptions, multiply it by the mills, work our way down to get this. This is a bad example of what's written here.
Okay, sec,
Huh?
assessed value times,
We're gonna go through an example in the book. Don't worry about writing this down, okay? Don't worry about writing this down, there's one in the book that's really simple. Let me just get a little far, and then you'll see how it works. We're actually gonna do 3 examples in this class before we finish this chapter. So you'll know, you want 4? Okay, I'll give you 4. All right, there's 3 steps to protesting your taxes. The first one is go to the county appraiser's office. Now, depending on what county you're in, it may be just as formal as you sign up, you show up, they say, what's your name? You say, Ray Clementi, thank you so much, have a nice day. If you're in Broward County though, my county, you go to Broward County, we got Marty Care. He's actually very good, he's very helpful, right? And if he can't attend himself, he'll have somebody to help you, okay? He's actually better than his predecessor, okay? Then, if that doesn't work, you can go to what's called the Value Adjustment Board. 25 days after you get your trim notice, which is a true rate in millage, once you get that, you can schedule to meet these people. Notice that there's 5 people, so a quorum, how many people do we need for a quorum? 3. It's majority people. You gotta put the word quorum, and you gotta put majority. So if there's 5 people, 3 would be needed. Notice that 3 of them are what? People of interest. You got 2 people in the county, and you got 1 person at the school. Then you got 2 private citizens. If that doesn't work, then you can go to the District Court of Appeal. Okay, at any one of these 3, it could work. If all 3 fail, what do you have to do? What do you do if all 3 fail?
pay the tax.
Pay the taxes. Because we learned, can they foreclose on your house?
Oh, yeah.
Yeah, it's a superior lien. You don't pay your taxes on April Fool's Day. In the previous year, your taxes will be auctioned off. After someone holds your taxes for 2 years, they'll get a tax deed which will trigger a what? Foreclosure. So make sure you get this down pat. Now, they talk about exemptions. Let's do immune property first. Government pays no taxes. It's automatic. Government pays no taxes, it's automatic, right? That's straightforward. Any government property pays no real estate taxes, they pay no type of taxes. Now, I told you the other day when we were doing the highlights, exemptions. We're talking about not-for-profit and churches. This requires human interaction. This is not automatic. You technically have to fill out the paperwork. It becomes a challenge, right? I had to fill out, to open a not-for-profit, I had to fill out papers to the IRS. I had to first file within the state, file papers into the IRS, then I had to file papers to the Department of Agriculture. So I can set one up. Okay, so that way we don't pay, not real estate taxes, but we don't want to pay income tax on the stuff we get. So it's not automatic. It required a lot of work. Once we got it, now it's automatic. Same thing is true. Once you get it, you're 100% exempt. Once you get it, you're 100% exempt. That means you don't pay any real estate taxes going forward. But until that point, it's gonna require a lot of legwork, right? We're all good with that. And if this will ever work.
Do you need new batteries?
No, I don't know. It's, the computer's acting weird right now. Okay, so we have something called Greenbelt Law. Greenbelt Law is referring to agricultural property. Agricultural property does not pay a lot of taxes. They actually get a benefit. Why do they have reduced taxes? Because technically, they provide you with a service. They grow the beef, they grow the chicken. They have the milk, they have the eggs. At the same time, that's not the only type of thing. You can have fruits. You can actually grow palm trees, and that's considered agricultural, right? Because it's sold to the state. So basically, a lot of developers abuse this, and they'll put cows on it. And they'll keep cows on it. Now, it's interesting that just because you have cows in it doesn't make it agricultural. If the property has been rezoned and you put cows on it, you actually gotta be in the cow business. Which means is that you gotta grow beef, you gotta sell beef. Right? You actually have to file tax returns on it. It's not as straightforward as just saying, I put a couple of cows and chickens, we're agricultural. They don't care that you farm the land for yourself. They wanna know that you're working with the public, right? So Lennar actually has to do what? They gotta be in the beef business, and they gotta sell it. And every year, they actually have to justify. They gotta submit paperwork, evidence that they're in the cow business. Okay, if they don't show it and they're not convinced, guess what's gonna happen? They're gonna be taxed on whatever the property now is zoned at. Because think about it, Lennar will buy large tracts of land. The large tracts of land tends to be what at times?
Empty.
What's it labeled? It's agriculture. Florida was one of the biggest agricultural lands, right? And it's starting to be what? Eaten away day by day because a lot of people are relocating to South Florida. There's tons of land in the middle of the state. And I'm sure there's tons of land in the sticks. I don't go to Tallahassee. But somewhere around there, there's like, huh?
It's not the sticks.
Is that the sticks now? But if you go more west, it's probably, right? It depends. So I don't go up there, I don't know what it is up there, but I know that I've driven up Florida and I'm up there like this. Like on the turnpike going to Orlando, there's tons of land. Right? That's all still farmland.
Can I sell you some?
Right? So, you know, we're starting to buy it up, and if you can't justify it, they're going to do what? Tax you on whatever it's been rezoned to. If it's been rezoned to residential, that's your highest and best use zoning. Guess what? That's what you're paying taxes on. So once a year, they definitely have to justify.
Is there a certain amount they're supposed to sell?
Nope.
Nope. They
They
can sell
just-
one cattle?
Nope. I'm sure there's a requirement.
Yeah.
It doesn't test in our stuff,
Okay.
so we ain't gonna worry about it. I'm sure one cattle's not gonna be enough. But if you have employees, like if you brought baby cows, that's gonna take a while before you sell them. Unless you sell them as veal, right? So it'll take a while, because those, I think they sell them when they're 4 or 5 months. Right? So it's gonna take a while. But as long as you got employees there and you're in that business, you can prove it, that's fine. Homestead. You can only have one property homestead. You file for homestead between January 1st and March 1st. Now, I've always made this promise. Since you guys are new realtors, if someone is relocating to Florida, should you advise them about homestead? Sure, you should. That adds value to the transaction. A lot of people don't know what homestead is. I lived in New York City. I didn't know about homestead because I always did what? Rent an apartment. My realtor did not help me in this situation, did not say anything. He added no value to my transaction. Okay, I talk about him all the time. His ears must ring every day when I teach real estate. Right? Because honestly, he was probably as dumb as nails. I did so many things that were technically illegal. I'd tell him I don't want to do this, I don't want to do this, I don't want this type of people, I don't want to do it, protected class type thing. He should have stopped me and disengaged. Right? And he didn't, and he never told me about this. You know how I found out about this? I happen to have family here. And my family was the one that told me. He didn't even tell me the fact that when you buy a house, whose tax benefit are you getting that year? You're getting the seller's. You're not getting yours. You're getting the seller. So if the property's not homestead, right? He's probably paying the maximum. If the property's homestead, then you're paying the lowest value now. And he didn't even explain that property taxes can go from $400 to like $3,000 next year. He had no clue. Matter of fact, you're not supposed to be able to explain that. What you're supposed to be able to say is, hey, you're buying a piece of property, do you know about homestead? Let me show you a little bit about this, blah, blah, blah. And by the way, here's a contact number I have at the local appraiser's office. Why don't you reach out to them so they can give you an estimate of what your property taxes are gonna be the next year? Someone asks you the question, say, well, we don't know, Mr. Seller, Mr. Buyer. They could have technically owned the property for 30 years and brought it at $50,000. Today it's being sold at $1 million. Their assessed value is probably a lot lower, and when you purchase that house, it's gonna be what? At $1 million assessed value. See, in Florida, the assessed value triggers in one of two ways. One is when you make an improvement to your house, just so everybody knows, every time you do a major repair to your house, you have to take out a permit, which then triggers a reassessment of your house. Okay? The other way it triggers if you do what? You sell your house. So when you sell your house, guess what? The assessed value changes. So you're gonna do this, you file for it between January 1st, March 1st. It is renewed automatic. You get a card sent to you just to verify that you do what? You're still living in the property. You don't have to do anything. The first time you file, you're good. You get a card every year to remind you that your property's homestead and it's gonna be what? Renewed. If you take your homestead property and you stop living in it and you make it a rental property, it is no longer your what?
Homestead.
So guess what? Should you be on homestead?
No.
No. You always have to be careful when you do this. How you doing?
I have a question.
Yeah.
You can only apply during January and March, you can't apply earlier?
Nope.
I got-
There's only a certain window. So it goes from January 1st to March. If you miss it, guess what happens? Next year. Okay? Matter of fact, you're gonna learn that if you're 100% disabled, you don't have to pay real estate taxes. But they have a definition of what 100% disabled means, right? So if you're 100% disabled, you don't have to pay real estate taxes. However, that won't be true for the current year. The current year, you'll still have to pay taxes. You'll have to, it's the following year. I did this for a lady up in Palm Beach Island. Her taxes are literally almost $400,000.
Oh my God.
Yeah.
Where does she live?
It's a $100 million house.
Oh, that's not.
It doesn't matter, that's still a lot of money.
Mm-hmm.
Okay? I was like this, really? Yeah. Right? And then I did that for free. She was like, don't let the door hit you, where the good Lord split you. I was like, so what you gonna do for me now, right? Nothing. But it's okay. It's called karma cleansing. This is what we were talking about over here. Okay? I'm gonna teach you this one, and I will teach you this one while we're here. We don't test this, so we're gonna test this one, and this is always a given. We're always gonna take this second 25,000. But I'm gonna show you how to calculate this one. Okay, all you have to do, let's say it's $70,000. They tell you the assessed value is 70,000, right? So I put B. All you're going to do, what's the maximum you can take? 25 for 25 is how much?
50,
50.
You're gonna subtract the maximum,
25,
and this is gonna be
20.
your deduction. It's not that difficult. You always subtract 50. The house is 65,000, subtract 50, what's gonna be your deduction? 15,000. right? It's not a very hard concept. It's straightforward. The ones we're gonna focus and the examples I wanna walk through are gonna be these two. I'm gonna do this one, but these are the ones I really want because those are ones that we get a lot of testing on. Okay. All right, now they give you additional property taxes. This is only to the basic. Only to the basic. So guess what's gonna happen? If you're a widower, they're gonna give you an additional $500 to your basic. Your basic deduction is how much?
25.
Right? If you're a widower and you're legally blind, you get 25 plus 500 plus 500, $26,000. If you're a veteran with a 10% disability or more, they give you $5,000. So, a veteran, forget about being legally blind or widow, they get this plus 5. So a veteran who has a disability of 10% or greater, basic deduction will be how much?
30.
$30,000. Okay? That would be $30,000. If you're 100% disabled, regardless if you're a veteran or not, you pay no real estate taxes in the state of Florida. You pay no real estate taxes. There's a full definition of what 100% means. You have to submit it. We're not gonna test you on it. I don't think the state tests you. I think what you need to know is that if you're declared 100% disabled, you don't pay any what? Real estate taxes. All right, let's go to the book and let's do some examples. We'll stop here because this is where I want to walk through. All right, let's go